In this chapter, we will be studying the international monetary system. And when we speak of the international monetary system, we are basically talking about a group of organizations that govern the exchange rates of currencies. And when governments allow their currencies to be valued by the market, the currency has a floating exchange rate. And when a currency has a floating exchange rate, the value of the currency can change from day to day. In some cases, the currency value can change hour by hour or minute by minute. But when governments value their own currency based upon its relative value to a second currency, the currency has a pegged exchange rate. And this occurs most often in developing countries. Now, some countries try to price their currencies in accordance with a hybrid strategy, sometimes called a dirty float. The countries will attempt to hold their value of their currency constant relative to the value of a basket of currencies rather than a single currency. And most of the time the currency value will float, but if depreciation takes root in the currency value, the government will intervene in order to maintain its target currency value. Now, when we think of a dirty float, we most often think of China, and although their currency is allowed to float, the float is only allowed within a certain range of values. If the Chinese currency starts to appreciate against the dollar, the yen, or the euro, then once again, the Chinese government will intervene. It is suspected that the Chinese government is doing this on purpose in order to hold down the value of their currency in order to promote exports. Now, many countries have a fixed exchange rate, and this basically means that the currency is fixed against another at an agreed upon exchange rate. And this system basically collapsed in 1973. The fixed exchange rate is sometimes referred to as the Bretton Woods system. Since Bretton Woods, some currencies float, some are managed, and some are pegged to another currency. And unfortunately, experts cannot agree on whether or not a free-floating market-based system is better than Bretton Woods. By 1880, most of the countries were using the gold standard in order to support their currency values. Now, what that basically meant was that the currency could be exchanged for its value in gold. If the US dollar was equivalent to 23.22 grains of fine pure gold, then anyone who held a US dollar could demand from the US government 23.22 grains of gold, and the amount of currency needed to purchase 1 ounce of gold was referred to as the gold par value. Now, the gold standard was popular with many countries because it allowed for ease in achieving a balance of trade at equilibrium. And basically this means that if a country was successful in export and it earned income from export, that amount would equal the amount that was paid for imports. In cases where a country would be purchasing more exports and their currency would be leaving the country, a reduced money supply would be a side effect. And the reduced money supply would push prices in the country lower. The country that would be receiving all of that currency would see an expansion in their money supply, and therefore they would see their own prices increase. Ideally, in order to avoid disequilibrium, the two countries would engage in trade, and they would continue trade until there was a balance of trade between them. Now, before we look at what occurred at Bretton Woods, New Hampshire in 1944, let's look at a basic side effect of operating under the gold standard. Now, under a gold standard, a country could arbitrarily set its value. And although this was not the original intention, between 1918 and 1939, countries were doing just that. Although it seems entirely within the right of the country to determine its own currency value, there was no consistency in practice between the currency values relative to gold. When someone received a unit of currency, they would immediately exchange it for gold due to concern regarding the value fluctuations. If you think about it, it makes sense. If someone gives you $1 today and you know that the dollar is worth 23.22 grains of gold today, but you also know that it is likely it will only be worth 15 grains of gold tomorrow, you want to convert your currency to gold today at the higher price. And ultimately, there was no confidence in the system. At Bretton Woods, the representatives of 44 countries met to deal with the economic systems. Most agreed that the proper currency value would be set by a fixed exchange rate practice. Both the International Monetary Fund and the World Bank were created at Bretton Woods, and the Bretton Woods Agreement also called for fixed rate regimes. Now, countries would still be allowed to set their exchange rates relative to gold, but they would not be required to convert their currency to gold on demand. And at this conference, the only currency that would be convertible to gold would be the dollar. At this conference, the price was set at $35 per ounce. The other countries would set their currency relative to the dollar. And the goal was to set the exchange rate. The goal was to set the exchange rate within 1% of the par value. Countries would enter the foreign market and buy and sell their currencies as needed to maintain that 1% target ratio. Now, the Bretton Woods system worked until the 60s. Remember, the only currency that maintained its convertibility to gold was the US dollar. Every other currency would set its value relative to the dollar, and the dollar enjoyed a fixed rate of exchange against gold. In essence, the dollar was equal to gold. And up until the time of the Vietnam War, the system worked well in order to finance the war. During that time when the United States had to finance the war, it created more dollars and expanded its money supply. And the expanded money supply led to inflation. And in addition, with the expanded government spending, the economy overheated and people began to spend a lot more money than they had spent before. With more dollars available in circulation, it was speculated that the dollar would be revalued against gold. In addition to the speculation about the possible devaluation of the dollar, speculators began to purchase large amounts of German Deutschmarks. The German banks also had to enter the market to buy Deutschmarks in order to maintain the exchange rate ratio between the Deutschmarks and dollars. And after this happened, the foreign exchange market became increasingly convinced that the dollar would have to be devalued. And the only way to make the devaluation of the dollar work, it required that all countries would have to agree to change their exchange rates as well. And because of this change, products could possibly be more expensive, and many countries hesitated to do it. And in 1971, the government announced that the dollar was no longer convertible to gold. And the government also announced a 10% duty on all imports until the revaluation of currencies worldwide was completed. And eventually the duty rates were removed and the currencies were revalued. And unfortunately, this didn't solve the problem. With all the new money that had been created, the U.S. market was still inflating. There were even rumors of a second devaluation. On a worldwide level, investors started to sell off dollars, and this heavy trading activity resulted in the markets closing on March 1st. And when the markets reopened on March 18th, currency values in several countries were floating against the dollar. And of course, many developing countries were continuing the practice of pegging their currency value to the dollar. And keep in mind that all of this was supposed to be a temporary solution. So the International Monetary Fund put in place the Jamaica Agreement in 1976, and at that time the currency values were allowed to float, gold was abandoned, and more money was provided to the International Monetary Fund from the member nations. Exchange rates since 1973 have been more volatile. All through the 70s, 80s, and 90s, different unexpected shocks to the world monetary system have caused this volatility. In general, from 2001 to 2009, the value of the dollar has declined. Now, you would think that with everything that has happened through the decades, that the debate about currency valuation would be over. That is far from the truth. Let's look at the floating exchange rates first. If a country does not have to maintain a fixed exchange rate, then it's free to increase and decrease its own money supply. Even though an increase in the money supply might cause inflation in the country, and the inflation would have an impact on the currency values, it would not have an impact on the competitive position of the international businesses. The international businesses still maintain a level of cost competitiveness. If a country developed a track record of importing more than it exported, leading to a trade deficit, domestic policy could prevail under a floating exchange rate system. This type of activity was not allowed under the Bretton Woods system. Only the International Monetary Fund was allowed to negotiate currency devaluations. So when we look at the case of fixed exchange rates, we have to take into consideration monetary discipline, speculation, uncertainty, and the lack of connection between the trade balance and exchange rates. Earlier in this video, it was revealed that under a fixed exchange rate system, the government would have to monitor their currency values and take appropriate action. Under a fixed exchange rate, the government of any given country would not have the authority to fix its own money supply under political pressure, and this would prevent exceptionally high rates of inflation. And because it's inherent in the nature of speculation to react to changes in the market of any commodity, floating exchange rates encourage speculation. And when a fixed exchange rate system is deployed, these unstabling activities are deterred. There is less uncertainty in the market, and acting under these assumptions, international trade and investment would be encouraged. There would be less risk. Now, although we know that a depreciation in currency will lead to inflation, there is still some argument as to whether or not a floating exchange rate will help in the adjustment of trade balances. After all, if a currency depreciates, it will boost inflation, and the inflation will wipe out any apparent gains or cost competitiveness that might arise. So where do we go from here? We do know that Bretton Woods did not work with a central currency pegged to gold. We know that it did not work with a single currency driving the entire valuation system. Speculation just crashed the system. Now we know from looking at the slide here that there are several different types of exchange rate policies. We've already talked about pegged exchange rates. Those are the rates where the value of one currency is determined by the value of a second currency. This essentially means that if the value of the U.S. currency increases, then the currency that is pegged to the U.S. dollar would also rise. Many smaller nations follow this regime. Typically, these countries do not experience high rates of inflation. However, if inflation were to occur, the governments would have to immediately intervene to make sure that the inflation rate does not exceed the inflation rate of the country's currency to which they're being pegged. Now, some countries use currency boards. And what this basically means is that the country has decided to agree to convert its own currency into the currency of a second country on demand. And this currency takes place at a fixed rate. Under a system like this, the government must maintain a certain amount of the foreign currency. Usually the foreign currency amount that is held is at least 100% of the value of the domestic currency it is issued. In other words, the value of the currency is fully backed by the value of a second currency. Under this system, the country would not be able to expand its money supply. If it wants to expand its money supply, it would have to require additional foreign currency. Now, although Hong Kong was used as an example in the book, there are several other countries who use currency boards. Some of the countries include Argentina, although they abandoned it, Bulgaria, Estonia, Lithuania. In the case of Argentina, the local inflation rates were higher than the inflation rates in the United States. And because of this situation, the Argentine currency was overvalued. Because Argentina operated under the currency board system, they were unable to adjust interest rates, and they ultimately abandoned the currency board. Even though the International Monetary Fund was originally responsible for providing a pool of money from which member countries could borrow to address the balance of payments issues, they also serve in a crisis management capacity. If we go on the assumption that a trade deficit would lead to a decline in the country's exchange rate, then a loan from the International Monetary Fund would not be necessary. Typically, the developed countries like Great Britain and the United States will finance their deficits with private money. But in recent years, the International Monetary Fund has become more active in crisis management, and it's been helping with the deficits of several member countries. South Korea, Indonesia, Thailand, Turkey, Russia, Argentina, Latvia, and Brazil have all received funding from the International Monetary Fund. Now, one type of currency crisis which may require the involvement of the International Monetary Fund is a currency crisis. And that basically means that the currency is under speculative attack. These attacks can result in depreciation of the currency. And under these circumstances, the International Monetary Fund will step in to stabilize the banks. Another type of currency, which would require intervention by the International Monetary Fund, is a banking crisis. A banking crisis is typically a loss of confidence in the banking system, and customers will rush to the bank to withdraw their money, and that's called a run on the bank. Another type of crisis is a foreign debt crisis. And a foreign debt crisis is a situation in which a country cannot service its foreign debt obligations. It doesn't matter if the obligations are private sector or government sector. The International Monetary Fund will assist countries in managing these types of situations as well. Now, since the Mexican government wanted to borrow money from the United States in 1982 to help them resolve their currency crisis, the International Monetary Fund allowed the Mexican peso to be pegged to the US dollar with a 3% tolerance plus or minus. And for almost a decade, it looked like this had solved the problem, since Mexican producer prices were increasing and there had been no adjustment in the exchange rate. Mexico was operating at a huge trade deficit because Mexico had expressed that they would continue to honor the pegged price. Foreign investment continued to flow into Mexico. But currency traders began to dump pesos on the foreign exchange market since they concluded that the peso would have to be devalued. The Mexican government stepped into the foreign exchange market to purchase all the pesos that had been dumped by the currency traders. And unfortunately, it lacked the currency reserves required to stop all the dumping. So ultimately, the Mexican government announced a devaluation of their currency. Investment monies were taken out of Mexico, and foreign investment into Mexico also declined. Again, there was a 40% drop in the currency value. The International Monetary Fund stepped in to stabilize the peso and to redeem the debt. And without the International Monetary Fund and the U.S. government, it is quite possible that Mexico would have had to default on its debts. In exchange for the assistance, the International Monetary Fund insisted on tighter monetary policies and cuts in public spending. Now, in 1997, a financial crisis hit the economies of Indonesia, Thailand, and South Korea. And in addition, the economies of Japan, Malaysia, Singapore, and the Philippines were also hurt by the crisis. Now, originally, the countries of Indonesia, Thailand, and South Korea had experienced unprecedented growth. Exports were driving the economies of these countries. The industries that benefited from the export boom were high technology products, automobiles, semiconductors, and consumer electronics. But because there was a favorable business climate, there was also an increase in investment, and many of those investments were made in commercial and residential property, industrial assets, and the infrastructure. There was heavy borrowing from the banks, and the government was spending large amounts of money on projects, infrastructure projects. Many of the businesses that were investing were closely aligned with the president of the country himself, and many of the businesses were allowed to operate in a monopoly. Now, most of the investment boom was financed, and as more investments were made available, the quality of the investments declined. And with all the investment that was occurring in the economy, which you would think would be a good thing, an excessive amount of excess capacity was also created. Prices fell, and investors and developers were unable to service their debts. And most of the borrowing that had been done to finance the investments required repayment in U.S. dollars. With a local currency pegged to the U.S. dollar, the government was unable to maintain the peg. The currencies depreciated, and the size of the debt increased. So as the financial crisis expanded, it became clear that several Thai financial institutions were on the verge of default. And due to all the overbuilding, developers could not sell their properties, and the numbers of credit lines that went into default increased. This drove the investors to the foreign exchange market to convert their currencies from Thailand currencies into U.S. dollars. And again, the size of the debts in Thailand were increasing as well. And Thailand could not finance the international trade nor service debt commitments, so they called in the International Monetary Fund. And the wave of financial decline did not stop in Thailand. The economies of Malaysia, Indonesia, and Singapore were also impacted. Singapore was probably the most stable of all the countries involved, and Singapore and Malaysia were able to handle their own currency issues. But in exchange for assistance, the Indonesian government agreed to close several troubled banks, reduce public spending, remove government subsidies on foodstuffs and energy, balance the budget, and unravel the personal relationships between the president and his investment partners. Before the crisis would be resolved, South Korea would also fall too. So when we look at the policies of the International Monetary Fund, there's been a great deal of criticism. The one-size-fits-all approach of the International Monetary Fund has been seemingly inappropriate for some countries, and this relates specifically to its macroeconomic policies. If a country is burdened with an exceptionally large volume of government spending, and in relation, the policies of the International Monetary Fund, if they're not thought through all the way, may not be appropriate. The second criticism is that the International Monetary Fund creates a moral hazard. And when people and governments know that they can behave badly and someone will rescue them from their bad judgment, it creates a moral hazard. And a final criticism of the International Monetary Fund is that they no longer are held accountable. With such a small staff, they cannot do an adequate job. And the recommendation is that the International Monetary Fund should be reformed to use more outside experts and to operate with increasing transparency. So this includes a lecture on Chapter 10. If you have any questions, please send me an email.